Have you ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions, are able to trade in a fair and efficient environment, have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance, as it is imperative for investors to be well informed in the fast-paced financial world. Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rule books of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hi everyone. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeCham. My name is Nazura and I will be the moderator for today's session. Our title today is Financial Health Check Mastering the Art of Analyzing Company Statements. When it comes to investing, understanding a company's financial health is crucial. Knowing how to read and analyze financial statements can give you a clear picture of a company's true well being. It is essential to identify the key indicators that reveal whether the company is thriving or facing challenges. So today, we are honored to have Ms. Pauline Yong to share her expertise on how to interpret financial statements. Sorry. Before we proceed, allow me to make a short disclaimer. Please be reminded that everything that is shared in this session is mainly for educational purposes, and by no way we are providing you advice to buy or sell any securities. You are solely liable if you make any investment decision. Now, allow me to briefly introduce our esteemed speaker for today. She is none other than Miss Pauline Yong. Miss Pauline is the CEO of Sigma Wealth Sendirian Berhad. She is also a certified financial planner and a licensed financial planner with Securities Commission license, CMSRL, and Bank Negara license financial advisor representative FAR. Miss Pauline is a best selling author, having published 6 books on investment and financial planning. Her insightful articles have appeared in various financial magazines, including Personal Money and Money Compass. With that being said, let us warmly welcome Miss Pauline Yong to the floor. Good day, Miss Pauline Yong. How are you today?
Hello.
I
Good
hope you are
morning,
doing well.
Nazira. Thank you for the introduction. Hi, everyone. Welcome. Good morning. Welcome to today's webinar. Okay, so shall I share my screen?
Yes.
Okay, so let me share my screen. So this is today's topic, financial health check. Okay, mastering the art of analyzing company statements. So this is what we're going to do today. We're going to look at the company statements. There are 3 of them. We have income statement, balance sheet, as well as cash flow statements. So besides looking at the financial statements, we are also looking at how to analyze a company by looking at the industry. So I will mostly focus on the numbers today, as well as some of the factors, like external factors as well. Okay, so in order to get the best out of today's session, it would be good if you to take note of the sources that I'm showing you later. Okay, because some of the sources, like for example, where to find the annual reports, where to find the financial statements, and where to find this and that. So those are the links on the website. So take note of all those links. Okay. And then, okay, so let me start. So this is today's agenda. So we're going to look at the components of the financial statements and analyze the financial key ratios, and to interpret the financial statements trends. So we have to look at the past figures and then compare to the current figures. So I will show you a few cases later whereby you will see that some of the companies, the earnings, they are progressing in a very, very rapidly manner. Okay, and some of the earnings or revenue is declining over the years. So then you know that those revenue that is declining over the years could be a sunset industry, right? Okay, then we will also look at the company financial performance with industry averages and peers. And finally, we will have the ETS session whereby I will show you the live demonstration of the Bursa Malaysia stocks online, whereby you can have a virtual trading account and then you can start to trade virtually. Okay, so that will be the last part. All right. So before I proceed, right, how many of you have not started investing? How many of you have not started investing? Anybody here, you are new in the stock market and then you want to learn more, but you haven't started. Anybody not started investing? You can raise your hand or you can say me. Okay, I see some me here. Okay, good. All right. I think many of you have started, right? And some of you probably just started maybe last year. Okay, and then maybe some of you just started this year. Nowadays, it's very easy to open the trading account. You can approach any of the securities firm, and then you just open the trading account. You can even open a trading account online as well. There are many sources. Okay, so let me, if you have any questions, feel free to write in the chat box or in the Q&A session there. Okay. So when we talk about value investing, right? A lot of the time people will link to Warren Buffett. Okay. Now I'm not going to play this video, but however, I'm going to share with you this YouTube link. Okay, so this is the YouTube link. And I'll copy and put it in the chat here. Okay, so that I will just explain to you the essence of it, and then the detail of it you can watch at home. Okay, so what Warren Buffett, the 7 principle, if you before you start investing, it is very important that you run through the Warren Buffett mindset. Okay, because a lot of time you are new and then you are fresh and then you listen to the rumors and then you jump into the stock market and then you make mistake. And when you lose money, then you shy away from the stock market forever. You say, I will never touch the stock market again. And that is the biggest mistake to me. If let's say you ever says that I'm not going to touch the stock market again. No, you have to, because in the long run, in order to beat the inflation, you can only invest in assets. Okay, only assets can appreciate with the inflation, the rate of inflation. So what are those? Will be the stocks and the properties. So these are the assets that will appreciate with the inflation. So if you say you want to shy away from the stock market, you don't want to invest, which means that you're going to put your money in the fixed income, and which means that it will be, you can't even fight the inflation. Okay, you can't even beat the inflation. So 7 principles, what are they? Number 1, do not lose money. Okay, so for Warren Buffett, he says that the very first principle of investing is that do not lose money. And then rule number 1 is do not lose money. Rule number 2 is do not forget rule number 1. So back to rule number 1. Okay, so do not lose money. Always tell yourself that you have to be careful with your money, and then you want to invest carefully, and you only invest in the best company. Okay, those companies that show that the fundamental, the financials is not right, avoid them. Okay, I will teach you how to look at them. Very easy. You just have to go to the right sources and then look at the very specific place where you can find all those past year revenue and the trend. Number 2, temperament is more important than intelligence. Okay, for Warren Buffett, he says that it's not about your IQ. You can have a top IQ in the world, but then you do not have the EQ. The EQ is to manage your emotion. So if let's say you can analyze the stocks very well, but however you do not have the EQ to avoid listening to rumors, because sometimes when we see that there are some noise, such as suddenly the US stock market has a crash, and then everybody was selling. For example, on the August 4th in Busan, Malaysia, we lost 74 points on one day. So a lot of people, they started to panic. Okay, when you see that the stock market lose, our Busan Malaysia lose 74 points, which is equivalent to about 6% on one day, that is a big drop, and many people started to go panic. And then when you go panic, you started to sell your shares, even though some of the shares are fundamental shares that you intended to keep for a longer term, but because you got panic and then you sold your shares. So then that means that you are not steady enough. So when Warren Buffett said temperament means that you are emotion has to be steady. Okay, you try not to be influenced by the noise so much. Okay, so that is number two, principle number two. Number three, focus on the business, not on the share price. Very often people look at the share price. So for example, I was asking some of the audience, I said that let's say you are given 10K and you're given 10K and then you want to invest in the utility stocks. So then I have two options for you. Either you invest in TNB or you invest in Malakoff. Okay, TNB is about 14 ringgit and then Malakoff is about 90 cents. So how many of you will invest in, which one would you go? August 5th, yeah, thanks. Which one will you invest? TNB or Malakoff? Okay, good. Deploy cash that day, all right. Ah, okay. So all of you are expert here. Okay. So sometimes when I ask this question, right, I will get answer as in oh, they want to invest in the one with the 90 cents stock, not the one with the 14 ringgit stocks, because 90 cents is cheaper to them. So they focus on the price. Okay, but luckily you guys are not focusing on the price. You guys are focusing on the value, okay, on the fundamental. And if you were to look at the fundamental, you see that the good fundamental, their PE ratio is very reasonable, around 20 or 20 plus, or not more than 30. But those that are not so good fundamental, their PE ratio could be very, very high, or they don't even have a PE ratio. Under what situation they don't have a PE ratio? Does anybody know? Under what kind of a situation you see the column in the PE ratio there is a blank? Okay, yes, when you're losing money, rugi, yeah, correct. So if the company is not even earning money, then how to calculate the PE ratio, right? You do not have the earning per share there. So so that is why for a value investor, you focus on the value, not on the price. Okay. Number four, turn out the noise. So Warren Buffett, he lived in Omaha for a long, long time, and then he doesn't like. People ask him, why don't you move to the Wall Street where you are closer to the stock market? He said he doesn't like the noise. Okay, because when I'm living in, if I were to live in the Wall Street, I probably would be a lot poorer than what I am. So meaning that when you are having too much of a noise, you get nervous, and then you get emotional, and then we ended up making the wrong decisions. And then number five, find your circle of competence. So this, what it means is that when you are investing, there are so many sectors, 13 sectors in the Bursa Malaysia. You have consumer, industrial, oil and gas, telecommunication, utilities, REITs, banks. So there are 13 of it, okay? Constructions, properties, so many. So you are not the expert in all of them. Okay, definitely you cannot be the expert in all of them. So then how do you select the stocks? So you find your own niche and your own strength. So for example, you are working in the technology sectors, or you are working in a telecommunication sector, or you are working in a bank. Okay, so if you are working in a certain industry, then perhaps you know that industry the best. Okay, so which means that if you are working in a bank, then probably you know that which bank is the best. And if you are working in the telecommunication industry, probably you know that which telecommunication stock is the best, company is the best. Okay, because you know the industry well, so you can see the strength and the weaknesses in each of those players. So if let's say you are not familiar with the oil and gas, and then people ask you to buy the oil and gas, then you have to be careful. So in order to buy the oil and gas, you have to be doing your own research about these companies, and then only you can make the decision. Okay, so you have to be investing in those stocks that you are familiar with. Okay, then number six, wait for the right pitch. You choose when to swing. What it means is that there are a lot of opportunities day in, day out. Every day there are a lot of recommendation or stock tips given to you. So you don't have to swing whenever there is a ball come to you. You don't have to swing. You can choose when to swing. So whenever there are so many stock tips coming to you, you just choose your own pitch, and then you just swing accordingly. So meaning that among all these stocks that are given to me, I will have to screen through them, filter them, and then just to see that their fundamental is good, then only I will pitch, I will swing, I will buy. Okay. So number 7 is that value investing is simple but not easy. So if you look at the rules there, do not lose money. Focus on the industry, not the price, and then do not listen to the noise and all this. These are all very simple principle, but it is difficult to follow. Okay, not easy to follow. A lot of time you know what is right, but then when it comes to investing, you get emotional and then you get carried away with the surrounding. Okay, when the people are doing this, you just follow. Okay, so these 7 rules are important for any beginners or even some experienced investor, important as well. Okay, next. So now let's take a look at the 3 financial statements here. So number 1 is the so you have income statement, balance sheet, and cash flow statement. Okay, can anybody tell me, as an investor, okay, so let's say we have investors, as an investors, which one of these to you do you think will have more impact on the share price, on the stock price? Which one of these will have more impact on the stock price? Okay, you have the income statement, you have the balance sheet, and then you have the cash flow statement. Okay, let's say you are the investor. Okay, which one of these? You can type your answer in the chat. Okay. Oh, I see that. Okay, I see about half. Okay, half of you say cash flow, half of you say income statement, and of course all are important. Okay, but which one is more impact, the most impact, like straight away it will impact on the share price? Okay, straight away when the figure come out, straight away it will impact on the share price right away, immediately when the figure come out. Okay, so when I say that, then I started to see more people giving me the right answer. Okay, yes, the answer is income statement. Why? Okay, quarterly, yes, correct. Okay, so the income statement is giving you the answer for the earning per share. Correct or not? Because every quarter the company will give announcement on their earnings, okay, on their revenue, on their earnings. So people and this earning per share, okay, for those of you who are new, what does earning per share means? So earning per share means that your net profit, okay, your net profit divided by number of shares. Okay, number of shares. So given the net profit figure, then you divide it by the number of shares, and then that will give you the earnings per share. And this earning per share is for you to calculate what? To calculate the PE ratio, right? And this PE ratio is the price over the earning per share, correct? So every quarter, this figure keep changing. Change. Every time when there's a news, this figure, the expected earning per share also change. For example, suddenly last year, MyEG announced that they lost the government contract. The government didn't want to continue terminate the contract, but later they resume. Okay, but the thing is that they terminate. When the news came out, the expected earning per share will drop. Then the share price will drop. Okay. 2 days ago, Gamuda announced that they had 4 point something billion of a contract won awarded by the Taiwanese government. And that day, immediately, Gamuda the expected earning per share will increase, and then the share price go up. Sometimes it's not the actual earnings, but the expected earnings as well. So what this shows you is that the earnings is super important. Okay, whenever there is a real actual earnings announcement or some news about that company about that will impact on their future earnings, and all this will in fact impact the share price immediately, almost immediately. Some even before the news announced, you can see the movement already. Okay, so that means there's some insiders information. So all these are telling us that the investors focus on the profit. Okay, let's say you are the bankers. Okay, if you are the bankers, you are thinking of whether do you want to lend the money. Okay, if you're the banker, you want to see whether you want to give loan to this company, then which one would you go for it? If you are the banker, which one is more important to you? Balance sheet. Okay, probably balance sheet will be more important to you because you need to see the balance sheet, see whether they have too much debt or not, whether the debt equity is still conducive to borrow money. Then only they'll look at their cash flow statement. So they look at the balance sheet first, the debt equity ratio first, then only they look at their cash flow statement. Okay, so so all these statements, all these financial statements, they are certain strength in them, that they are of a special interest for certain parties or certain users in the market. Okay, and maybe who is more concerned with the cash flow statement? Investor as well. But however, investors who are more to the dividend. Okay, if let's say you are the dividend kind of a person, then you probably will focus on the cash flow statement. Okay, because dividend person means that you don't look at the price, you don't care whether today up or down. You just focus on, do I have the dividends or not, correct or not? So if let's say you are the dividend type of investor, then you focus on the cash flow, because the cash flow will tell you whether you have enough money to pay the dividends. Okay, for the REITs, okay, the REITs, number one is the balance sheet, because the REITs, they are looking at whether you're having debt or debt equity, whether it's healthy or not. So that's looking at the balance sheet. But also people are looking at the cash flow, because REITs are also the dividend stocks. So for REITs, you will have to look at the cash flow statements for the dividends. Okay. Share price over the earning per share. Yes, correct. So PE ratio is your current share price divided by earning per share. Correct. Okay. All right. So let's go on. So in order to help some of the audience here who are new to the stock market, you probably have not seen a financial statement before. Okay, so if you are some of those who haven't seen, you are from the engineering background or you are from the IT background, so probably you haven't seen a financial statement. Okay, so when you look at this financial statement, you see that there are revenue, and then there are some minus the cost, and then you see that there is a profit. Okay, profit means that your revenue minus your cost, and they give you the profit. So then this profit, you have before tax and after tax. So when we want to calculate the earning per share, it has to be the net profit after tax. Okay, the final profit figure. So that is the most important, net profit. Okay, because this one will determine the earnings per share. Okay, so, and sometimes you see that the earning per share, the figure here, you have basic earning per share and diluted earning per share. So what's the difference? Basic earning per share means that the net profit figure divided by the number of shares give you the basic earning per share. Okay, but what does diluted means? Diluted means is that, no, it's not after tax. Diluted means that your number of share expanded or increased because of the ESOPs, because of the corporate exercise, such as rights issues and things like that. Okay, so sometimes you have ESOPs. employee stock option. So if you have ESOPs, then you see that the number of shares increase. So then your net profit is being diluted by a larger number of shares. Understand? Okay. So then that is the income statement. Next, we look into the balance sheet. So the balance sheet, we are looking at the position, okay, the financial position of a company, whereby basically in a layman term, it will be net worth. Okay, so you're looking at the net worth of the company. Okay, so I'll bracket here net worth. So what does net worth means? Net worth means that your net worth of the company, which means that your total assets minus your total liability become your net worth. Okay, so that is your net worth. Means that you will have to find, for example, people ask you, how much assets do you have? What is your net worth, personal net worth? Then you try to figure out, oh, how do I have a house? What assets do I have? Do I have a car? What stocks do I have? Do I have a stock? Do I have unit trust? Do I have bank balance? Also all the total assets. And then you have to minus your liabilities, your loan. Do I owe the bank's money? Okay, so you have to minus all the mortgage loans, car loan, and things like that. So then the net figure will be your net worth of your personal net worth. Okay, so for company, same thing. So if let's say people want to know what is they call it the book value as well. All right, the book value. Oh, what is the book value of this ABC company? So then you know that they are asking for the net worth. Okay, the book value, the net worth, and then the net tangible asset. They are all referring to the same thing, net tangible asset. Okay, book value, net tangible asset, net worth, all these are referring to the same thing. So how do we get the net book value? So the book value is actually looking at the total assets here. Okay, so this is the total assets, which is made up of your current assets and your long-term assets. Okay, both of these short-term and long-term assets, which is your total assets, and then minus your total liability. Okay, and your total liability is made up of your current liability and your long-term liability. Then only will give you the your net worth. Okay, so let's say you are looking at total assets 200 and something, and then minus the total liability, and then that will give you the balance, and that balance will be your net worth. Now let me ask you so can I say that, okay, so let me ask you so if let's say I want you to identify a figure here, okay, a figure here that tell me the net worth without calculating. Okay, without calculating this one minus this one, can you identify the figure of the book value? Can you identify the figure of the book value? Ah, okay, who is this? Si-ong. Okay, Si-ong. Yes, you are right. Equity. Okay, so Si-ong gave me the right answer. So if let's say I ask you to straight away tell me the book value, so you don't have to use the total asset minus the total liability. You just go straight direct to the total equity here. And then this answer here will be your answer, your net book value or your net worth or your net tangible assets. Okay, so your equity here. Why? Because of the formula. Okay, so the balance sheet is such that the assets must be equal to liability plus your equity, correct? So this is the balance sheet formula. So which means that you have, this is your balance sheet, and then this is your assets, this is your liabilities, and then this is your equity, correct or not? So your assets figure here must be equal to this plus this. This liability plus your equity must be equal to the total assets. Okay, so if let's say I go by this, okay, A equal to L minus E. Okay, and if let's say I say total asset minus total liability, right? So then it will be A minus L equal to E, because total assets minus total liability is equal to the equity. So when A minus L is equal to the E, then isn't it E is A minus L is equal to the net worth, okay, the total net worth, which is the book value. So isn't it the E is become the book value, NTA? Yes, net tangible asset, correct. Okay, isn't it the equity is also equal to the net tangible asset, which is equal to the book value, isn't it? Okay, so therefore you are looking at a financial statement whereby it can straight away tell you the answer. You don't have to calculate, straight away you look at the equity, then that equity part will be your net worth. Now, why some of the companies, sometimes they will be classified under the PN17. Okay, occasionally Bursa Malaysia will have PN17. Securities Commission, they will announce that certain company will fall under the PN17. Okay, occasionally you see that, oh, this company become a PN17, like AirAsia became a PN17, and then from PN17 and then uplift to back to the main board. Some didn't even uplift, and then it will be straight away delisted. Why? And that's because this part here, the equity here. So when company, they started to see that their equity is getting smaller, and then become negative, then the Securities Commission will see that this company no longer fit to be listed on the Bursa Malaysia, not fit, okay? Because you are having a negative equity net worth. How can you have a negative net worth on the Bursa Malaysia? So then it will be classified under the PN17, whereby you are supposed to have a year for you to restructure your debt. And then after that, if let's say you are okay, then you can go back to your main board. But if let's say you still cannot, then you'll be delisted, okay? So then this will be looking at the balance sheet, okay? So then next, the cash flow statement. The cash flow statement is whereby you are looking at 3 sections. Number 1, you have cash flow from operation. Okay, then operation will refer to the net working capital. Okay, the working capital. The working capital refer to the current asset minus the current liability. Okay, how fast your company turnover in terms of the operation. Okay, so this will be in terms of your operating activity, how fast your company turnover in terms of your stock. You bring in a stock and then you convert into a service and then you deliver to the customer, and then you collect money from the customer. So meaning that you are converting the stock into sales, and then from the sales, then you can pay your supplier. Okay, so that's how the working capital is being run. So the more efficient it is, the more healthy it is. Okay, so you don't want to see whereby the cash flow from the operations is negative, because if it's a negative, it means that the company, you are not able to collect fast enough money, or your sales are not good enough, and then at the same time you are paying your supplier. Okay, so which means that you are in terms of your running of the business, you are running into a negative situation, okay, which is not healthy. Then number 2, the second section of this cash flow will be cash flow from the investment activity. Now, investment activity will refer to, okay, so you can see that some of the item will be buying the equipment. Okay, so if let's say you purchase the property, plant and equipment, so then that will be a big cash outflow. Okay, so if let's say you you sell your equipment and plant, then you have a positive money coming in. Okay, so this section here is what the analysts call as a capital expenditure, CapEx. Okay, sometimes you hear that, oh, you want to find out what's the CapEx for this Maxis or Axiata, what's the annual CapEx. So the CapEx is from here. Okay, that means that you want to find out how much money that they are paying out in terms of the investment on the capital expansion. Maybe they buy a new factory, maybe they buy a new equipment or something. So these are all capital expenditure, and which means that money going out, which means that they're paying out. Okay, so under this section, right, would you want to have a positive or a negative? investment activity here. Would you want to see a positive figure or negative figure? Okay, type in the chat. Positive or negative? Okay, only one person answer. Only Kiki answer. Okay, yes, right. Okay, very good. Yes, correct. Okay, so here we want to see, if you are a healthy company, we want to see a negative figure, which means that you are expanding. Okay, we don't want you to sell your property or sell your land in order to cover your operating expenses. We do not want. However, during the pandemic, 2020 to 2022, okay, these 2 years, we do see quite a number of the companies, they are disposing their land or equipment or something. They want to get cash to cover their operating expenses, because during the pandemic, the business was affected. Okay, so they have to sell something in order to cover their operating expenses. But that one is understandable. But after that, then we do not want to see that anymore. Okay. Okay, then next, the cash flow from financing activity. So this third section here tell you about your financing decision. Okay, now, in order to know what is your financing decision, you go back to your balance sheet again. Okay, so your balance sheet here, you have your liability and your equity, right? And then this is your assets. Now, normally, when you look at a balance sheet like this right-hand side of the balance sheet, which is made up of the loan and the equity. Loan means that you borrow money, loan, right? And then the equity means your own money, your shareholders' money, your own money. Okay, or your capital. Okay, so when you are looking the sources of financing, sources. Okay, when you are looking at the sources of financing, which is your own money, okay, you are looking at how to raise funds, how to raise money, then the only two options for you will be either you borrow money or you come up with your own money, shareholders' money. Okay, either you borrow money or you come up with the shareholders' money. So therefore, exactly when people are looking at the financing activity, we are looking at either you are borrowing money or repaying money, something to do with the loan, or you are having a corporate exercise. You are having a rights issues, or you are preference share or whatever. You are getting money from the shareholders. Okay, so these two will be grouped under this financing activity. Now, when you are borrowing money, okay, borrow money, when you borrow money, it will be positive cash flow because the money coming in. So it will be positive cash flow. And then when you are paying down the loan, that means you want to pay down the loan, then it will be negative. Okay, so tell me, financing activity, would you want to see a positive figure or a negative figure? Financing activity, would you want to have a positive figure or a negative figure? More answer? City? Very good. Okay. Yes, correct. Okay, another item here is a very, very important for the, just now I said dividend investors are very, very concerned about the cash flow statement, right? So where is it? It's here. Okay. The financing activity, the first item here is dividend payout. The dividend payout will be under the financing activity, whereby it will be money going out. So it will be a big negative. So if you are a dividend stocks, okay, you have dividend stocks like banks and utilities and all these consumers, okay, you probably most likely you will see that you have a negative in the financing activity, because this is the part whereby you give out a lot of dividends. So this one for investors, they want to see negative. So you have positive here and then two negatives here. Then you are considered a healthy company. Okay, so which means that you are looking at a company whereby you are able to generate enough of a cash flow from your operation side, because your operation is your day-to-day business running, okay, day-to-day business running. So you are able to generate enough money from the day-to-day business running, and then to give dividend to the shareholder, and then to give investment to expand your business, so that you can derive more money, generate more money. Okay, so a healthy company, you should be able to see this. Generate as much money from the operation, and then to give out dividend to the shareholder, and then to invest in the plant and machinery. Okay. However, under special conditions such as the pandemic, then you will see that you will have negative figure from here. Because of the pandemic, you have negative figure from the operation, and then you will have positive figure from these two sections, positive, because you need to borrow more money to finance your operation, or you need to sell your land in order to finance your operation. Okay, so that is under like a recession time. Okay, so it's different. So you have to see if under normal situation the company is doing that, that means something is wrong. Okay, it has to be under special situation, but not the normal situation. Okay, understand? Okay. You mean this one, cash flow from the operation? Okay. Okay, free cash flow. Free cash flow is a formula whereby you have to use the EBIT. There's a formula, EBIT plus depreciation minus the net working, increase in the net working capital, and then there's a range of the formula. You have to apply the formula, and the free cash flow is for people to apply into the discounting cash flow method for valuation method. Okay, so today we are not going into the valuation method. We are just focusing on the financial statements. So we focus back to the financial statements here. Okay. Okay. So do you have any questions on this? Is it these slides? Okay, if you have any questions, you can ask me. You can type in the chat. Okay, to do before I proceed further. Okay. So next, let's take a look at analyzing the financial ratio. So there are different category. Okay, we have the liquidity ratios, we have the solvency ratio, and then the most important is operating. Yes, because that operating cash flow is for you to generate enough of a cash flow to give dividends, okay, to expand your business. So that operating cash flow is the most important. Yes, you must see a positive there, then you can have a negative in the other two sections. Okay. Okay, so then we look into the liquidity ratios and solvency. Liquidity is looking at how fast, how efficient the company, whether it is healthy with a healthy networking, with the working capital healthy or not. Okay, so later we will look at this. So this liquidity ratio, we are looking at the current ratio, whereby is the current asset divided by the current liability. Okay, the cash flow ratio is the cash over the current liability. So all this ratio financial, right? So where can you find? Okay, so I'm going to bring you to some of the website here. Okay, there are a few websites that I want to introduce to you. The first one is called Bursa Marketplace. Okay, so I give you the link. So this is the Bursa Marketplace. Yeah, yes, for most business, correct. Okay, because for banks, do you have a different sets of concern, because just your balance sheet alone is opposite of what other normal banks, normal business are doing. For banks, you see, for banks, the money that they collect from the people, okay, when you are the bank, right, you collect deposits from the people. So this deposit, the cash that deposit to the bank, right, is not your assets. The cash you receive, right, is not your assets. It's not the bank's assets. It's the bank liability. So that's why for banks, it will be the opposite. The liability, you see that the cash coming in and then become the liability. And then the loan, because the bank, they extend the loan, give out the loan to the individuals, to the businesses, right? When they create the loan and give out the loan become the assets of the company. Okay, so that's why I do not want to confuse you. I didn't want to talk about the banks. So I just talk about the majority of the business whereby you are looking at that balance sheet as it is. Okay, so the valuation as that the normal is that you have the assets equal to the liability and then the equity. Okay. Okay, so here I want to introduce to you 3 websites whereby you are looking at the Bursa Marketplace. Okay, so this Bursa Marketplace, you can see, you can find the industry information. So for example, you want to see, compare among the industry, among the peers, this is the website. So you can click Bursa Marketplace and then you have to sign up, log in, then only you can search. So you click the search bar. Let's say you want to search for Maybank. Okay. Let's say you want to search for Maybank. Okay. So have to log in again. You can log in with your Gmail. Okay. So I have already registered before. So I just log in with my Gmail and then log in with my Gmail. Okay. So then you can use the search bar. Oops. Search bar. Okay. So the search bar, let's say, then you type in Maybank. Okay. Then you see that there is like a page on the Maybank with the score. So this one is by the alpha indicator score, whereby the highest is 10 marks, 10 score, and then the lowest is 0 to 10. Okay, 1 to 10. So this number 8 score is considered quite a good score. Okay, so you download the report here. So you can see that here we are looking at the Maybank. And then, although this report is a bit outdated, it's August 2nd, okay? But however, we can see the industry information here. Okay, so this is the industry information whereby we can see the banks, all the banks. Sometimes you may not include all the banks, but majority of the players will be here. And you can compare them among the peers. Okay, so for example, you see that for these various banks, you can compare according to their market cap, according to their performance, their price performance return, according to their PE ratio. You have the trailing and the forward. Trailing means the rolling 4-quarter. Okay, the rolling 4-quarter earning per share, meaning that each quarter they announce the earning per share, and then they have to subsequently add 3 more quarters in front, so that you have 1, 2, 3, 4. You have 4 quarters, rolling 4 quarters to make up to 1 year. Okay, because every time when there's a new earnings announcement, then that quarterly earning per share have to be added together with the previous 3 quarters earning per share, then to make up 4 rolling quarters earning per share. So then that will give you the latest, okay, latest PE ratio. So this is the trailing PE ratio. And then you have the forward PE ratio. The forward PE ratio is based on the forward forecast or future forecast of the earning per share. And this earning per share forecast of the earning per share normally will be done by the research analysts in the various fund houses, research houses. Okay, so the research analysts will have to forecast the future 12 months target earnings, and then they will calculate the forward PE ratio. Okay, so you see, normally the forward PE is supposed to be lower than the trailing PE. Okay, supposed to be lower. Okay, then you can see the dividend. yield, okay, how much of a dividends that the investors are getting, and then the net profit margin. Okay, and this net profit margin will be the net profit after the tax. Okay, net profit. Okay, so here, so we are looking at a comparison. If you do see across here, you can see the comparison, and then you can see that among these, which one has the lowest PE ratio, which one has the highest dividend yield, and which one has the highest net profit margin. So from here, you can see their development. I mean their performance. Okay. Okay. Another website I want to introduce is this website. This website is the i3 Investor. Okay, i3 Investor. You under here you can see that you have Malaysia and then Australia, all this. So particularly, I find that Malaysia and United States, these two are worth for you to save the pages. Okay, Malaysia has a lot of information which I'm going to show you later about the trend. Okay, the profit trend, the revenue trend. And United States, this one also for the stocks as well. Okay, so this one I will show you later. So the third website, this one I think you guys will know this. Okay, so I will put it here. Okay, then the third website that I want to share with you is the Yahoo Finance website. Okay, Yahoo Finance website, it has the balance sheet. Okay, under the financial here. Okay, under the financial here, you will see that you have income statement, balance sheet, and cash flow statement. Okay, which you can't find in the other two websites. Okay, so each of these websites, they have their own special function. So for example, if you want to know the details about the balance sheet, the income statement, and the cash flow statement, you come to the Yahoo Finance. So if let's say you want to know about the trend, like 10 years revenue trend, 10 years dividend trend, okay, you want to know the 10-year trend, you come to the i3 Investors. For Bursa Marketplace, if let's say you want to know the industry, okay, you want to compare, you want to make comparison with the industry, you come to the Bursa Marketplace. Okay, so then you have this three website, save it. Okay, save it because you're gonna use it very, very often. As long as you want to research on a certain Bursa Malaysia stocks, you can always refer to these three websites. Okay, of course there are other websites, but then today I just want to focus on these three because these three, I think you'll get a lot of information. Okay. Okay. Then just now we were looking at the current ratio, right? So the current ratio, you have to look at the balance sheet here. Okay, you click the balance sheet. And then you click the total asset, the drop down button, you click it. Sometimes they will give you the info, but sometimes they don't. Okay, depends on whether they are giving you the info or not. So this one I try to click here. Okay, so here you can see that you have all these current assets and then the long-term assets. Okay, and then you have total assets, long-term equity investment, derivative assets. So these are all assets. And then you have all these are loan. Okay, so these are the because this is a Maybank. Okay, so as I said, the Maybank, the loan become the assets. So sometimes when you see loan, don't be surprised. Okay, because the loan become their assets already. So you see that these are their cash equivalent, their loan, and then their receivables, their prepaid assets, and all other assets. So these are the details of the assets. And then the liabilities, you can also see this as well. You click and then you can see all this. The total deposits become their liabilities. Okay, you see? and then all these long-term liabilities and things like that. And then you click the total equity, then you see the stockholders equity, shareholders fund. Okay, stockholders means the shareholders fund. So if let's say you want to find the do the calculation, maybe you can come to Yahoo Finance, okay, because Yahoo Finance will have all this breakdown, okay, and then as well as the cash flow statement, same thing, okay, they will have the breakdown as well, and then the operating, investing, and financing, okay. There is no drop down button, so which means that you will take the figure as it is. So operating cash flow is this, investing cash flow is this, and then the financing cash flow is this. So do you see that it is healthy? Because this is positive, minus, minus, okay? Okay, capital expenditure and then things like that. So, okay, so this is a free cash flow. So meaning that even though, okay, because the operating cash flow is not enough to cover the dividend, what the company is doing is that the operating cash flow not enough to cover the dividends. So sometimes when that happens, which means that they will withdraw money from their reserves because they have a pool of accumulated profit as a reserve. So we have to withdraw money from the reserve and then to pay off the dividend. Okay, so normally we want to see that their operating cash flow is enough to give the dividend. So that will be the, so in this case, the dividend payout may be, okay, probably maybe more than 100%. Okay, if that is the case. Okay, so we want to see that the dividend payout has to be less than 100%, then only it can be sustainable. Okay. Okay, so you can see that for certain years, this one is more than enough to cover, okay? But for certain years, it may not be enough to cover. So there are plus or minus, okay? Okay. All right. Then we'll go back to the slides. Then we look at the solvency ratio. When it comes to the solvency ratio, we can look at the balance sheet because under the balance sheet, we have the debt and the equity, okay? So you can see that the debt equity, they are, we can go back to just now the Yahoo Finance. Okay, maybe I show you another share. Okay, let's say, what share do you want? A consumer share, okay, Nestle, Berhad, okay. Nestle is also a dividend stock as well. Okay, so then we click the financial. And we click the balance sheet. Okay, we want to see their debt equity, right? So we click that balance sheet, and then we can see that their total assets, total liability, and then their total equity here. So in terms of the debt equity, oh, okay. So here actually the debt is rather high. Okay, so you can see that the debt level is quite high. So let me show you another cash-rich company, okay, Inari. Inari is a cash rich, so you'll see that maybe it will be different. Okay, so here you will see financial. Okay, balance sheet. Okay, so you can see that the total assets here, okay, is more than covering the total equity here. So which means that this company, right, is very strong in their assets, okay? Especially you see that current assets is 2.4 B, okay? Which means that if you to look into the detail, there is, I'm not sure whether I can see, oh, cash, okay? So if you to look into the detail, you can see that the cash equivalent is 1.8 billion, okay? So this is a cash-rich company. So from here, you can see the more detail about the company. But if let's say you want to see from the i3 investors, you can, but it will be more like a summarized version. Okay, so for example, so this one is an NVIDIA. Okay, so you can see that under the financial here, you have summary, okay, and then the quarter. Okay, so normally for this, you can look at the overview first. Okay. And from the overview, then you can see the key financial ratio, okay, such as a P ratio, and then you can see okay, not much. Okay, we go to the Malaysia one. Okay, Malaysia overview Maybank. Okay, we can see that we have the more information here. So we have the PE ratio, dividend yield. We have the net book value. This is the net tangible asset. The NAPS means net tangible asset per share. And then we have the net profit margin. So these are the key information of an investor who wants to know. So from here straight away, you know that, oh, this company, the PE ratio is only 13, okay? And then the dividend yield is so good, it's 5.6. And the current net book value is 7.88, which is more or less same, not too far away from the current 10 ringgit, okay? So which means that this company is quite reasonable in terms of their valuation. Okay, so this overview here, you can have more information. Okay, and okay, okay, so let me go back. Okay, so then when we are looking at financial ratio, we can rely on certain websites like the i3 Investors, Bursa Marketplace, as well as the Yahoo Finance, these external websites for us to see more information about the financials of the company. If let's say you are the kind of person whereby you want to download the annual reports or the income statements, okay, so there's a place for you to download that as well. So here, you go to the Bursa Malaysia company announcement. Okay, you go to Bursa Malaysia and then you click company announcement, then you will come to this place. Okay. So Bursa Malaysia company announcement will have all the announcement about the quarterly results or the changes in the shareholders or all the information. So particularly people are eager to find out about the quarterly results, they will wait at the company announcement section here. Okay, so for example, you know that let's say Top Glove is going to announce the earnings today after 5 p.m. So then you have to stand by here and then to keep on refreshing the Top Glove page and then just to see the announcement here. Okay, so you have to do, if let's say they're announcing at 12 p.m. Time, then you have to stand by and then you keep refreshing and then until you see the announcement coming up. Okay, so this place is for you to extract the annual reports, and then you want to download, you can download from here. Or another way to get the annual reports is by Google. Okay, for example, you can say Gamuda annual reports. Okay, then you will see that it will link you direct to the website of Gamuda annual reports. Okay. Yeah, correct. The company website, yes. So here you can see direct, you can download. Okay, you download, and then you can see. Okay, it will take some time, but anyway, you know where to get the information. Okay, so I repeat, if let's say you want to gain access to the annual reports, then you can go to Bursa Malaysia website, company announcement. Okay, you click the company announcement on the homepage, and then you can search for the information, or you go to Google search, direct search. Okay, you just type in the company name, annual reports, and then it will link you direct to the website of the main company. Okay. From where the peer report, you mean this one, Bursa Marketplace? You mean this one? This one is from Bursa Marketplace. Okay, so you see under the Bursa Malaysia website, you have the main Bursa Malaysia website, whereby your company announcement, everything will be in here, Bursa Malaysia. Okay, then you have the Bursa Marketplace. So Bursa Marketplace is for you to find all the reports here. Okay, you can download the reports, or you can go to the research here, and then you have other people's analyst report as well. Okay, you search the research here, and then you have all these other analyst report. Okay, so this Bursa Marketplace is for report. And then you have Bursa Anywhere. Okay, Bursa Anywhere is for you to know your CDS account information. And then you have the Bursa Academy. So later on at the end of the session, I will bring you to the Bursa Academy, particularly the simulator, the stock simulator, whereby you can see how the actual Bursa Malaysia is being simulated on this platform. Okay, whereby you have a virtual account, you'll be given 100,000 ringgit of virtual money, and then for you to buy stocks on the platform. Okay, so that is the Bursa Academy, which I'll come to this later. Okay, so there are a lot of information here. So particularly today, I will be focusing on the Bursa Marketplace and the Bursa Academy here. Transfer the share Bursa Anywhere. So this one, you can download the app. Okay, you download the app onto your mobile app, and then register account, upload your IC, and then you will see that all your CDS account will be appeared in this Bursa Market where Bursa Anywhere app. So meaning that if let's say you have opened 5 trading account with 5 different brokers, then all these 5 different CDS account will be listed on your Bursa Anywhere app. Because sometimes when you open an account, you forgot about it, and then you bought some shares, and then you forgot about it. So by doing this, then you can consolidate all your CDS account under one app. And then you can transfer the shares also. So meaning that when you see that, oh, this ABC broker is cheaper in terms of commission. So you want to transfer from one broker to another broker, you can use this Bursa Anywhere app. Okay, each transfer is 10 ringgit. For each stock, 10 ringgit. Okay, so it's very convenient. Okay, so let's go back. So these are the financial ratio, liquidity, solvency, profitability ratio, whereby you look at the profit margin, and then the valuation ratio, whereby you look at the pricing. Okay, valuation means the pricing. The price, whether now is it undervalued or overvalued. So these are all ratios that people are looking at. Okay, so particularly for this one will be the PE ratio, price to book ratio. Now, among these 4, right, 1, 2, 3, 4, okay, 1, 2, 3, 4, liquidity, meaning your current asset over your current liability. This one you want to be greater than 1. Okay, solvency, debt over equity, this one you want to be less than 0.5. Okay, you have the liquidity, you have the solvency, you have the profitability. Okay, the net profit you want to be for certain industry lah. Okay, 20%. Okay, so consumer banks 20%. Okay, but there are certain industry that are less than 10%, but then this is the profitability ratio, the net profit margin that you are concerned with. And then the valuation, which is the PE ratio. PE ratio less than 20 times. Okay. Also, different industry will have different average PE ratio, but in like for mostly general, it's less than 20 times. Okay. Okay. So if let's say you are the investor, okay, can you choose which one to you will matter you the most? Which means that if you are the investor, which one you will concern the most? As an investor, okay, will concern you the most? Which one? Is it the liquidity ratio? Is it the solvency ratio? Or is it the net profit margin? Or is it the PE ratio? Which one will concern you the most? Okay, tell me. There's no right or wrong. Okay, it's just that if you give me your answer, I know what is your objective. I know where you are looking at. Okay, which one you think is important to you? Okay, so Siwa says that it's valuation. I can't see too clearly. Okay, today I didn't wear my glasses. Okay, so valuation, profitability. Okay, valuation. Okay, I can't read too small the words, but anyway, I can see that valuation, profitability, yes. So for those of you who say that you are looking at the valuation, okay, meaning that you are most likely, okay, you are looking at the price movement, okay. It could be you are more to the short term or medium term, okay. So you are focusing on the short term or the medium term, whereby you want to make sure that the price that you buy is really low enough, so that you can take advantage of the price gain. Okay, you are more to the price gain, okay, capital gain. Okay, you are more to the capital gain. For those of you who choose the profitability, right, you could be looking at your dividend. Okay, you are the dividend guy. Okay, you want to receive dividend. You want to make sure that this company is earning enough to pay you the dividends. Okay, so there is no right or wrong. It depends on what is your objective. So you can have both, meaning that I have a portfolio whereby half of my portfolio are looking at dividend stocks, and then the other half of the portfolio is looking at the capital gain. You can have both. Okay, so in the end, you see yourself focusing mostly on these two only, mostly. Okay, but however, there are some investors, they are very concerned with the debt equity and then with the cash reserve. Okay, they will say that, oh, this company is a cash rich company, buy. Oh, this company is zero debt, buy. Okay, so some investors, they are very concerned about this. So then they will put this as their first priority, and then they will buy according to this preference. So I wouldn't say who is right or wrong. Okay, I wouldn't say whether this is correct or wrong. You have your own reason, you have your own objective. Probably because you think that when you are buying a company whereby the cash reserve is high, or that they have no debt, it is very safe for them. Okay, so purely it's up to your judgment, because when you are the investors, you look at your strength and your own weakness, then you select the stocks that are suitable for you. Okay, for me, I will prefer to look at the profitability as well as the valuation. Okay, to me, the debt equity is not so important. Because why? Because we are operating in a low interest rate environment. The whole world is going to reduce the interest rate. Okay, so we are looking at a low interest rate environment. So I'm not too concerned with whether this company is having too much debt or no debt or whatever. Not so concerned. Okay, in terms of the cash reserve, this could be due to probably you borrow a lot of money, okay, and then your cash reserve balloon to a figure. So to me, cash reserve, as long as the cash reserve is of a reasonable amount, okay, not too low, then it is reasonable. Okay, I'm not so concerned about the cash reserve. Okay, I'm more concerned is the profitability. Okay, the profitability, because the profitability measure the industry. Okay, tell you the information about the competition in the industry, whether this industry is competitive or not. If let's say it's very competitive, very difficult to earn money, then you see that your profitability ratio could be on the low side. And which means that your business model is based on volume, because you need to have a lot of volume, then only you can make the amount of money. Okay, so there's also no right or wrong, because there are certain industry whereby it is really based on volume. For example, the utility. Okay, you check, go and around and check, and then most of the utility stocks are below 10%, and that is because they are going by volume. Okay, the margin is smaller. Okay, and there are certain industry like banks and the consumer stocks, 20% is norm. Okay, so this 20% as a norm, probably they will give more dividends as well. Okay, but however, there are some company whereby their profitability ratio is high, but the dividend payout is small. Can you identify? Okay, which company their profit margin is high, but then the dividend is small? Okay, this kind of a company, okay, you will find that you may not be interested in the end. Initially you may buy, but if let's say you see that every year you don't give enough you don't receive enough of a dividend, so in the end you probably will sell it as well. Can you identify which company are like that in Busan, Malaysia? There are quite a number, okay. Okay, in Nari, yeah, you can say that. Okay, we have a lot of cash reserve, but then keep it for themselves because they want to withstand the technology harsh environment. Another one is MyEG. Okay, their profit margin is 50%, more than 50%. Okay, their profit margin is more than net profit. Net profit is more than 50%, but their dividend yield is 2%. Okay. Okay, so you will see that when you are looking at a company, also some of the banks are like that. Hong Leong Bank, okay, where their net profit margin is the highest among all the banks, but their dividend is maybe 3%, okay, which is same as the FD rate. Okay, so that makes a difference. Okay. Okay, some say what is a value trap? A value trap is when your PE ratio is very, very low. So which means that you are forever operating in a very, very low PE environment. Because PE ratio, the lower the better, correct? Okay, PE ratio means that the lower the better, means that your price over your earning per share, okay, whereby this earning per share is high, but then your price is low. So you are actually operating in a value trap. You are value stocks because you have low PE, but you are trapped in a situation whereby your price is not increasing. So you're undervalued, okay? You're undervalued, no doubt. From the PE ratio, you're undervalued, but your price doesn't go higher, okay? So what is the ideal PE? Depends on the industry. Consumer banks are less than 20, okay? Around 20. And for a certain industry like technology, you see that technology, the norm is about 30, 40 currently, okay? 30, 40, which is high. To me, is high, okay? And then you have construction, okay? Construction, okay, let me tell you, last year, when I saw the construction company were all trading at below 10, I really like screaming like, oh, that is like below undervalue. Okay, construction stocks were below 10. Okay, now the construction stocks are 20, 30. Okay, so now the construction stocks are higher now. Okay, so which means that the valuation is not so attractive. Okay, but that's a sentiment in the market. The sentiment in the market such that they are willing to pay. They are willing to pay for that industry. So you can see that the PE ratio is on the high side, and that is the sentiment. It reflects the sentiment of the market. Okay. Okay. That small word I can only see management stingy, whatever. Okay, but the too detail I cannot see already. Okay, maybe the Nazura can help me to read. Okay, but anyway. All right. Okay. Next, we move on to the strength and the weaknesses. So the strength and the weaknesses, when looking at the company, we have to see their trend, okay? Their revenue growth trend, their earnings growth trend, and the market growth trend. So the revenue growth trend, we analyze the historical revenue growth rate, which means that when you look at their revenue growth, it has to be a healthy growth. Okay, later I will show you some case studies, and then you let me know, you tell me whether this company is healthy or not. Okay, And then only I will show you the figure first, then only I review you the stock name so that you don't have any bias. Okay, so I flash you with the statistics, with the numbers, and then you straight away you tell me good or bad. Okay, so later I will show you that. But first, you want to see a strong revenue growth. Okay, and then but also compare with the industry average and the competitors as well. Okay, because whether you have this revenue growth depends on the industry, whether you are in the sunrise industry or you are in the sunset industry, and then whether you are in a competitive industry environment or you are the monopoly or oligopoly. Earnings growth, okay? Revenue is just the sales. Then the earnings will be the net profit. So the net profit also has to be running hand in hand together with the growing together with the revenue. Okay, has to be hand in hand. There are some company whereby the revenue is growing strongly, but the earnings growth is less strong. So meaning that the revenue is very steep rise, but the earnings are less steep rise. Okay, so the revenue here is very good growth, but the earnings less. So under this kind of a situation, I do see what happened is that the share price will be rising. Okay, it says that the share price will not rise according as the percentage of the revenue, but it will rise according to the earnings instead. Okay, it will rise, but then it will rise according to the earnings, not according to the revenue. Okay. So market trends, identify current market trend impacting the industry. So this is something that you have to read, lots of reading. You have to keep reading and reading. Assess the company's ability to adapt and capitalize on this trend. Okay, so for example, AI trend. Okay, whether the company are able to capture this trend or not. Okay, and for example, ESG trend, whether the company is able to capture the ESG trend or not. Because all these are important. So you have to study and then do a lot of reading and then to judge whether this company is having some form of a investment into this area, AI plus ESG. Okay. Okay. Let me see. Let me see clearly. Okay. PE is relative, depends on peer-to-peer comparison. Yes, correct. So let me elaborate on that. Go back to the PE ratio here. So just now, I show you this one, right? So here you can see that the PE is comparative. So when you say that Maybank is 13 times, then you have to compare to others because others are also low. So therefore, you see 13 times, whether it's undervalued, overvalued. Okay, to me personally, I feel that it is still undervalued for the banks because the bank stocks in the past, 2015, 2016, 2017, they were trading, sometimes they are trading as high as 18 times. Okay, 18 times. So therefore, this 13 times, 12 times, to me, I think is still undervalued. Okay, let me show you some other PE, industry PE. Okay, let's take a look at some construction. Okay, Gamuda. We can look at the construction, and then we can look at the technology. Okay, so that you can have a feel of comparatively, relatively. Okay, the meaning of relatively. Okay, so Gamuda, you can see that their PE ratio at one glance is 20 over, 30 over, some 40 over. Okay, so it's on the high side. But I can tell you, last year when I showed this to other people, they are on the low side. Okay, so which means that sometimes when you see that when they are across the board all are low, doesn't mean that they'll be forever low forever. Okay, doesn't mean that, because this exactly last year they were below around 10, 11. Okay, some even below single digit. But now you see that they are all in a double digit, and some even 30 and 40. So which means that things will change when there are certain sentiments factors or certain news. Okay, when it comes, there are certain news, and then it will affect, and then the whole industry PE ratio will all rise. Okay, and but definitely when we want to compare the PE, we have to compare across the industry. Okay, then I show you another one. Glove, top glove. Okay, fresh. Download. Okay, so here you can see that in terms of the PE, these are very, very high, right? But can anybody tell me, okay, based on your memory, 2021, what was the industry PE? 2022, I think, 21, 22, 21, 22, like that. Okay, what was the industry PE for this one? Okay, anybody remember the glove industry? No, not 2020. 2020 it was like that. 2020, but there was a time whereby the PE ratio was super low. Can anybody recall? Yeah, 2020 was 100 times. Okay, I agree, that was 2020. But in 2021, I think in the 2021, end of 2021, it was as low as how many? No, not 20. No. Nobody can tell me? No. It was as low as 5, 4, 3. The PE was as low as single digit. Now it's negative lah, okay, because they are making losses now already. But I'm saying that when they are making a lot of money, but the share price was very, very low, they keep selling the share price, so you see that their PE ratio was super, super low. Okay, so the industry PE will reflect what is happening during that time. So during that time, 2020, when you just had the pandemic, the share price increased 10 times, okay, because of their average selling price of the gloves increased more than 10 times, 20 times. So then the share price increased also according to the average selling price, okay? So then you see that the PE ratio was super, super high, 100 times, 80 times. And that was because the share price was way ahead of the historical earning per share. The historical earning per share was, based on the published figures, right? Which is historical earning per share. But the future expectation of the earnings is very high, so they are willing to pay a very, very high price. So then you see that the PE ratio was super, super high, 80 times, 100 times. And then come to a point whereby people see that we have the vaccination, and then this glove demand will be declining, and then there are a lot of suppliers also producing the gloves. Okay, at one time, remember Masing also said that they are producing the gloves. Okay, so we have all those news that all kinds of companies, not including, I mean, besides Malaysia, from other parts of the world are also producing gloves. You are looking at the whole mass production of the gloves suddenly. So then you see that supply and demand issue, and then the price of the average selling price keep dropping. So then the share price keep dropping from, for example, top glove from 10 ringgit to 2 ringgit down to 1 ringgit. Then the P ratio was single digit, 2, 3, okay? So it was very, very low. So then people think that it was value. If you think that the PE ratio was like having 5 times of a PE ratio is a good value, then you have to think twice. Because normally if the PE ratio is too low, it is also not a good news, because it means that the industry is having a problem. The investors are not willing to pay a high price despite the historical earning was good. The investors are not willing to pay a high price. So which means that the PE ratio is super, super low. Okay. So now you see that what happened is that the after the pandemic, right? Because of oversupply and lack of demand. So you see many of these gloves companies are actually operating in a loss situation. So you don't even have a P ratio. And then even if you have the earnings, you have a very super high PE ratio because your earning per share is super, super small. Okay. Yeah. Okay, so this is what it means, okay. Too high, you have to be careful. Too low, have to be suspicious. Yeah, correct. Okay. Yes, correct. Okay, too high, no good. Too low, also no good. Okay, so you have to be reasonable. 10 to 15, I think is considered okay. Okay, 10 to 15. It also depends on the industry. Okay. Okay, good. Okay, let's continue. So let me flash you some case studies so that you can tell me the answer. Okay, so you have to compare with the industry as well. Okay, and you can get all those information from the analyst report. And always remember to look out for industry trend. Okay, consider the players, who are the players, and then all these are changing. Okay, all these are changing because the industry is the one that shape the profitability of the individual stocks within the industry. So you have to study the whole industry. You don't study the company, you don't study the management itself. You don't tell me that, oh, the management is super good. They are very good and honest and transparent. But if let's say you are operating in a harsh environment, no use. No matter how good your management is, you are no use. Okay, because you can't fight the environment. You can't fight what is happening in the world. You can only manage your own company, but you cannot fight what is happening in the world. So you have to learn how to adapt to it. And the adaptation will need time. Okay. So okay, let me see. I'll try to read. You have hence investing is hard. It's easy, most people won't lose. If easy, most people won't lose money, correct. Growth stocks like technology stocks have high PE. So how to justify buy or sell? Okay, so Steve, this one you be your own judgment. You make your own judgment. Personally, I don't buy. Okay, because if the PE ratio is too high, I don't buy unless the company is from either US or China. US or China tech company, I may buy. Okay, because these are the global world leader in terms of the technology company, and they are leading the technology world. So these are the leaders, maybe I will buy, even though the PE ratio are high. You get what I mean? So you have to make your own judgment. Okay, in the end, you are responsible for your own profit or loss. Okay. Okay, that's to the investor to justify the valuation. There's no clear cut. Yeah, correct. Because a lot of time, okay, if investment is so easy, right? Why not many people are like Warren Buffett? Why only a few people can be identified as successful as Warren Buffett? Why? And that is because when Warren Buffett see the industry, he has his own sets of thinking. Okay, just like when I see the industry, I have my own consideration. And then when the fund managers see, they have their own consideration. And then when another person see, they have their own consideration. So different people will have different perspective. So in the end, you are the one who decide whether you want to take on the risk or not. So if let's say under the consideration, under the assessment, you discover that there are too many unknown factors. So if there are too many unknown factors, then you have to ask yourself, do you still want to go ahead to buy this stock? Do you? Or you want to give it a pass, and then you go to invest in some stocks that you are familiar with. Okay, you don't have to swing at any ball, anything that come to you, don't have to swing. You have to be answering to yourself. Okay, say for example, okay, oil and gas and plantation, these two sectors are something that I'm not familiar. So when I'm not familiar, then when I want to invest, I have to be extra careful. Okay, maybe I will put like a time frame. I will invest for certain reason for certain time period. After the time period, I will sell, because I'm not expert or familiar in this industry. So I'm not gonna buy and hold for years, 10 years. No, I'm not. Okay, so I can't see too far for these two industries. So I can only see year by year. Okay, and or by the news. Okay, so you have to look at the industry as a whole. Circumstances, Warren Buffett will allow him to be the best investor, which most of us don't have that. Okay, he was started investing as a teenager. Okay, so some people, they started investing as like a passion, because when he was young, his father was a stockbroker. So he naturally grew up in the environment whereby the father was always analyzing the stocks. So at the age of 10 years old, he started to buy his first stock. So some of you, whereby probably your parents can be a remisier or a fund manager, or so you are naturally growing up in that kind of an environment, then naturally you'll be more interested in the investing. So perhaps you probably will learn more when you are at an early age. Okay, so it also depends on your background as well, whether you are a successful investor as well. Okay, so the SWOT analysis, I'm not going to go into the detail, but basically these two are referring to the internal strength of the company, internal. Okay, these two, opportunity and threat, are external factors that you cannot control, you can't control, but you can try to mitigate, to adapt to it. Okay, so your internal strength and weakness refer to the management. Okay, whether the skills of the workforce, the management, whether they are good, and all the internal methods and their technology, whether it's good to adapt to the outside world. Okay, so all this. And then the external will be the factors. It could be the interest rate, it could be a macroeconomic factors, it could be your competitors that is coming right after you. For example, you produce a product, you think that you are having a competitive advantage, but one day another company come up with a better product. For example, BYD. Okay, for example, Tesla lah. Okay, we look at Tesla first. Tesla come up with a pure EV car. Okay. Oh, everybody was so crazy about Tesla, pure EV car, how nice. Okay. So then BYD come up with a plug-in hybrid. Okay. And then suddenly everybody turned the head to the BYD. Oh, plug-in hybrid. Oh, this one has two. You can have the best of both worlds. You can have the petrol, and then you can have charging. How nice. Okay, so when you are enjoying your profit, okay, and you're enjoying the success of your product, then suddenly your competitors are coming out with another new product that is even perceived as better than your product. Then how would you feel? How are you going to compete with them? Okay, so these are the things that are happening beyond your ability to control. You can't control what other people invention. Okay, but what you can do is to mitigate. So for Tesla, I think if they can, they have to also come up with a PHEV car. If you really want to fight with them, you have to come up with a PHEV car. Otherwise, the market share of the PHEV may in the end overtaken by the EV. This one may overtake this. Okay, looking at what is happening in China at the moment, this is increasing at a very, very fast rate. Okay, and it may overtake in the end. Okay, but okay, anyway, case studies. Okay, tell me, this company good or bad? Is it a good stock? Okay, you see, from 800 million, 2 billion, 4 billion, 5 billion, revenue increasing. Okay, and then the net profit, negative, negative, negative. Okay. Okay. No good. Correct. No good. Okay. Can you guess what company is this? Okay. When I tell you the company, you may say, oh, I may have bought this stock. It is capital A, Asia. Okay, Asia. Okay. So next, this one. Okay, beginning 1.3, 1.4, 1.4. Okay, and then the revenue is also going higher. Okay, 800 to 1 billion. Okay, and then their net profit margin is super high. Good. Okay, what is this? Hong Leong Bank. Okay, it's a bank, Okay, next, this one. This one, 900 million, 2 billion, 1 billion, and then 500 million, 400 million, 500 million. And then the revenue last time 1 billion, now negative, and then 31 million. Okay or not? Aha, Eugene. Okay. Yes, yes, yes. Okay. Yes, it's a glove counter. This one is Hartalega. Okay, Hartalega. So you see, from the fundamental here, you can see straight away whether this is good or not. So it's very, very simple. So isn't it? It doesn't take you too much of your time. So before you invest, make sure you check their trend first. Okay, where do you find the trend? Okay, you go to the i3 Investor here. Okay, and then you click the financial quarter. Okay, i3 Investor, and then financial quarter, you click. Okay, then you will see the past 10 years revenue. So for example, this Maybank, from 8 billion revenue quarterly revenue to 11 billion to 13 billion to 14 billion to currently 17, 18 billion. Okay, and then their net profit from 1.6 billion, 2 billion to the currently 2.5 billion. Okay, so you see that their net profit do not grow as fast as the revenue grow. So that's why their share price didn't grow as fast as the revenue. Okay, their share price grow steadily, but not as fast as the revenue grow. Okay. I show you that another one. Okay, this one is the NVIDIA. Same thing, under the financial, you click the quarter, then you can see the past 10 years. But I think for US, this one is more than 10 years. It's all the way from 2007 to 2005, 20 years. Okay, so this one is 20 years. So you can see that 20 years ago, 18 years ago, they were having a quarterly revenue of 800 million, then slowly hitting 1B in 2014, 1B, 1B, all these 2017 still about 1B, 2B like that. Okay, can you guess how much is now? Can anybody guess how much is now? 1 quarter, how many billion of USD they are producing on a 3 months basis? Can anybody guess? Okay, you see, 2019, 23B, okay, 2023, 2024, you are now looking at 30 billion. Okay, 26B correct. Okay, so Eugene, you are right. 26 billion, 30 billion. The latest is 30 billion. Imagine you started with a 1B company and then now become 30B. So can anybody do a simple mathematics? That is how many times? 30 times. Revenue are 30 times. So if let's say you are looking at the share price, it's also 30 times as well. Okay. Okay. So now let me go to the ETS section here. Okay. So, so ETS section is whereby just now I mentioned to you the Bursa here, which is the okay. You click the Bursa Academy. Okay, you click the Bursa Academy. Copy this link to you. Okay, so especially for those of you who wants to have just learned about my way of assessing the company, and then you want to try on the Bursa Malaysia stocks, and you want to try with virtual money or paper money, this is the platform. Okay, you have to register first. Who have not registered this? Can I see a show of hands? Who haven't registered this one? Bursa Academy. Okay, if you haven't registered, can you please register? Okay, with your any of your Gmail. Okay, once you register, you will select simulator here. Simulator, you click equity simulator. Equity. Okay, so we're going to look at the equities today. So then you will come to this page. Okay, so this is what is happening now. Currently, it's live. This is live. Okay, this is a live one. So, and then you are given 100,000 ringgit as a virtual money to buy, to try, okay, to invest, to learn how to invest. So what you can do is that first you have to create a watch list. Okay, so you can create a watch list here. So here I have created 3 watch lists. I have a watch list on technology stocks. I have a watch list on dividend stocks. And then I have a watch list on the property and construction stocks. Okay, so I have these 3 watch lists. So these 3 watch lists is for me to monitor the prices so that I want to invest. Okay, so you can do that as well. Yeah, looks like the Afin Huang, yeah. It's under P2P. Okay, so so that means that Afin Huang also subscribe to P2P. Not P2P, I mean end-to-end, sorry. End-to-end, sorry. End-to-end, okay. So you can see that here for the technology stocks, I have all these tech stocks. And then so you see that the tech stocks are in red today. In fact, majority of the stocks are in red. You can see that 600 over are in negative. So majority are in red. And then the dividend stocks, at least you see some green and red as well. So dividend stocks are more resilient, okay? And then you see the property and construction also in red because people are profit taking as well. So that is looking at today's. Okay, repeat how to register. Yes. So here, I log out first. Okay, then I go to Bursa Academy, right? And then you click register. Okay, then you see that register, you key in your name, your email address, contact number, and then your password. And then you have to type the code here, 768. Well, your code will be your code. My code is this one. Okay, then you register. Okay, within a few seconds, then you can log in already. Understand? Okay, so this is a very, very useful website whereby anybody can try how to learn how to invest. Okay, so now I log in. So this is my dashboard. Then I can go to simulator and I go to equity simulator. Okay. Then I come to here. Okay. So because I already created the watch list before, so I just continue with the watch list. For what is the URL? What do you mean by URL? Because this is just a website. Okay, so you just have to go to Bursa Academy website. Oh, I see. Okay, then I have to go to here, Bursa Academy. Okay. Then Bursa Academy, this one, I give you this link. Okay, I give you this link. You click the link and then you click register. Okay. Okay, so I repeat, what is the process? So when you are looking for stocks, okay, you want to create some watch list there, so you can come to the investor, i3 investors, and then to see the trend, okay, the trend of the stocks. So for example, you are looking at Gamuda, then you click Gamuda, and you can see their overview here. What are the key ratio, and you can go to the financial, click the quarter. Okay, look at the quarterly trend, and then you see whether it's healthy or not. So for Gamuda, you started with 600 million, then 1 billion, then now it's 3 billion, then now it's 4.7 billion per quarter. Okay, from here 600 million to the current one is 4.7 billion per quarter. And then the net profit 100 million, 200 million, and currently it is about 272 million. So meaning that their net profit is growing at a slower rate than the revenue. Okay, so then you can see that their net profit margin also declined. Before they still have double digit, but now it's all single digit. Then you have to ask yourself why. Why do you think that the Gamuda, their net profit margin actually declined over the years? So for me, number one, I think that it could be because for Gamuda, they have a lot of government projects from Australia and from Taiwan, especially Australia. Australia is a country whereby they are very concerned with the ESG. Okay, so in order to win the government project, right, your company has to be ESG first. Okay, in terms of the way you operate, in terms of your handling of your supplier and things like that. So in order to maintain the ESG status, right, I think probably that costs some money to Gamuda. Okay, so maybe that will, and also when all these government project normally the profit margin is also very smaller than others. So which means that their profit margin is also smaller for these kind of projects. Yeah, correct. ESG friendly and all this. So that will impact on their profit margin. Yes, you can revise back this video because LiveChamp YouTube channel has it, and also Bursa Malaysia YouTube channel also has it. Okay, so you can after today's, maybe a few days later, then they will upload into their YouTube channel. Then only you can rewatch them. Okay. Yeah, Gamuda Taiwan MRT, right? The outlook. Okay, so it depends on what is the profit margin. Because for what I know is that for construction company, right, when they tender for the contract, is the winner with the lowest bid will win. The winner with the lowest bid, which means that your price has to be the cheapest. So in order to win the government project, your price has to be the cheapest, then you can win. So which means that your margin cannot put too high. So that's the thing for construction. Okay. net profit margin more than 100%? No, net profit margin cannot be more than 100%. Okay, net profit margin can never be more than 100%. Why? Because your net profit is divided by your sales. How can your net profit more than your sales? Cannot. That doesn't work that way. Okay, so net profit margin has to be below maybe certain. Okay, normally it's about 20% of a net profit margin is considered very good for a public listed company. Normally you can find that 20% of a profit margin in banks, in the consumer stocks. For certain industry like properties, some properties company, maybe you can see that. Okay, and then plantation, some plantation company, maybe you can also see that double digit of a net profit margin, but normally it could be single digit. Okay, also depends on the price of the commodities. So all of these are reflection of the industry, okay, the whole industry, and as well as the competitive level. Yeah, that's right. Okay, so I think we have come to the end of today's ETS practice will be just now. Okay, so we have come to the end of the session today. So I hope you guys have picked up the skill. So before you buy any shares, make sure you run through their revenue trend and their fundamental first before you put the buy button. Okay, focus on the fundamental, not the price. Okay, so thank you so much. Yeah, thank you. And then I'll pass back to Nazura.
Okay, thank you, Miss Pauline Yong, for your invaluable insights and wonderful sharing with us earlier. We will now proceed to the Q&A session. I encourage all attendees to submit any questions you may have in the Q&A box so that Miss Pauline can address to your questions accordingly. But since we do not have much time left, we will just take one or two questions.
Any other question? Because I suppose I have answered their questions also.